What is going on, everybody, and good morning. Today we are talking about what I think is the greatest tool, I guess, or concept in real estate investment, and that's a sale leaseback. So if you are familiar with the BRRRR or the buy, rent, rehab, refinance, and repeat method, this is like put on your big people pants because this is the next step up for leveraging your capital, building out or improving a real estate asset, and then pulling all that capital back out and going to do it again, or just simply getting your money back from doing it. So if you're not familiar, really quick, high level before we get into it, a sale leaseback is when you, as a property owner, perhaps you own the building, or no, you do own the building. That's the point of it. You operate a business out of it, and because of the way that real estate and commercial real estate is valued, it is valued off the incomes of a property and not necessarily the physical property itself. In leveraging that concept, you're then able to sell the building with your business or person or whatever in it as the income, with like a history of operation and everything, to a private equity group or some other investor who's just looking for that passive income stream backed by commercial real estate. And then you're able to pull all your money back out through that transaction of basically selling the real estate, keeping your company in there under a lease, and then essentially paying rent to that new person or that new owner of the building. However, now you're able to pull any improvement money or any build out money that you pull into it back out and go do that again, or I don't know, buy a boat, whatever the hell you really want to do with it. But the point is that it's not locked up in that building. In where people struggle with this concept is that they feel like, oh, if I have my money in my real estate, it's always safe, it's always going to appreciate. And while that's, excuse me, and while that's normally how this works in residential and in multifamily and those kinds of things, it's a little different in commercial. And by multifamily, I mean like small multifamily. And it's all based on how properties are evaluated. So let's go over a couple of concepts in case you don't really know. This is very high level. There's a lot of nuance to this. So please understand, we're really just scratching the surface here. If it's something you're interested in, I'm happy to go more in depth with you. There's plenty of other resources out there on YouTube, Google, whatever. But here it is. So in commercial real estate, you will talk about something called the net operating income and the cap rate quite a bit. So if you're not familiar, the net operating income is on a building. It's all the income you get minus the expenses, not including debt. So it does not account for your mortgage. And the reason for this is it allows us to compare assets in commercial real estate that are similar, but they're not so similar that, like, they have the same beds, baths, all that kind of thing like you normally see in residential. So it's the value of the property is based on the income. However, you can have a property making $1 million a year, but if it costs you $1.5 million to operate it, it's not a very good investment. So this is a way to kind of weed those out and know, okay, if I'm making $1 million a year, it costs me 200 grand a year to operate the building, operate the business of the building. Then you've got an 800 grand a year net operating income. That's not really how it worked. That'd be a very good efficiency, but you get my point. Cap rate is if you purchase a building in cash, what is your annualized return? So meaning your monthly return, your monthly NOI times 12 for the whole year. What is that return divided by the purchase price for the building? So what this allows us to do is when buildings trade on the market, and they trade hands and are bought and sold, it allows us to kind of compare like-kind buildings or like-kind investments of similar quality, of similar income levels, of similar risk level, and apply that across the board. And the reason for all this is because if you've ever bought or sold a home, you understand that your home is compared to other homes that have sold on the market. And that's how we come up with the value in real estate. Usually it's called a comparables method, something like that. When you get income involved, it allows you to compare, oh, that 20 unit down the road to the 15 unit over there, or the office building over here to the office building over there, even though they're not the same layout, they don't have the same bathrooms or whatever. maybe they're the same class of building. Like in offices, you get into different classes. In industrial and things, there's different nuances. So it allows us to kind of level the playing field and compare buildings and understand like what are buildings and assets trading at. And that's what the cap rate does. It allows us to take basically to get to a valuation or to get to a purchase price. You do the opposite. You take your net operating income, which is how much you make in a year annualized, and you divide it by that cap rate. So if multifamily, say you're in multifamily and you're looking at a 15-unit building, and you know that the other 15 units in the area have traded at, call it a 7 cap, right? So you can take the net operating income of that building, you divide it by that 7% or 0.07, and then you get what is a fair market evaluation for that asset. So hopefully that all makes sense, because we're just going to go deeper now. When you're talking about commercial real estate, there's also something called triple nets or net expenses. This is the idea that when you're leasing a space, you are required as the lessee, I should know this, doesn't matter. The person leasing the space, you are responsible most of the time in commercial real estate for triple net expenses, or you'll sometimes hear it called CAM expenses, but it's basically the taxes on the building, the utilities obviously are separate, the maintenance expenses for the building, and that was the third one for triple. It's anyway, sorry. It's all the expenses in the building depending on the deal. The point of this is that they're all on a per square foot or pro rata basis, meaning if you're in a retail strip center, you only account for, say, 3,000 square feet of the 100 and whatever square feet of the whole strip center. You're only responsible for those expenses associated with the square footage of your space. So in another way of saying that, you're not going to be paying expenses. The expenses are for the whole facility, and then they break it down on a per square foot basis. You're only responsible for that cost per square foot times 3,000. That makes sense. Another concept we have to understand before we get into this is the idea that any money you spend building out your space, if you're going to lease a space, any money you put into it to build it out, to make it yours, anything like that, like if it's a restaurant, you're going to put in like freezers and a grease trap, and maybe you're going to improve the front of the building, and whatever you're going to do to make it for your business, that's on you, the operator of the business, going into that space in the real estate. That's really only worth something to you. You're not going to get any of that money back at the end of your lease. Like, it's not there. Now, there are ways in the lease that we negotiate to get credits from the landlord, depending on how the building's delivered and the nuance of the deal and how expensive it is and how nice the building is and stuff. We most of the time are fighting and working to get the operator or the tenant money from the landlord to build the space out, either in free rent or in a check. Sometimes it totally depends on the situation. I've seen all in any of those happen. However, you have to understand that whatever that money is you put into it is only worth something to you, the operator. Like, unless you leave and you find someone who is operating a very similar business to come in, but even then, they're not really going to pay a premium. It's not like in residential where you go into a building, maybe the kitchen needs updated, you update the kitchen and the cabinets and you paint it, you put in new flooring, yada, 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 and then you get that value and that equity back out of it. You kind of have to completely get rid of that idea if you're going into commercial and going to operate a business, because that can really hinders your ability to scale in this arena. So now that we all kind of understand that, what the hell is a sale leaseback, right? A sale leaseback is the idea that is you, the operator of a business, buy the building that you operate in. You operate a good business, you build it out, you then have yourself on a lease. So you would normally probably have a separate LLC. Your business that's operating would lease the space from that separate LLC. Those incomes that you yourself are generating to that business then are capitalized on a cap rate, and you come up with a value. And there are many people and many institutions that will then come in and say, hey, you're running a pretty good business. You know what the hell you're doing as an operator. I want to buy the building you're in and you pay me rent as you have on your lease. And normally those are pretty long-term leases, like 5, 10, 15 years, depending on the industry. And they pay you basically to buy the building, but they're really buying the income that you're putting into the rent. Well, first thing people normally say is, I don't want to rent my space if I already own my space. Why would I want to do that? And that's really the limiting idea that gets a lot of people hung up, because they're still thinking about it like a residential property. And what they have to understand is that they have to kind of get out of their own cheap way here and understand that, one, if you're a business operator and you're renting your space, there's a lot less risk. You can theoretically just like walk away. You can get a sublease in there. You can negotiate a rent buyout. There's a lot of ways to like just get out of there. I mean, look what the hell Elon Musk is doing with Twitter's offices, and he's like not paying bills basically because he knows that the office market is crashing and he can, get out of it with lawyers and all that kind of thing. Now, I'm not saying don't pay your bills and be a grifter like him, but the idea is that the risk is less if you don't own the building. So why is this so powerful? We kind of already alluded to it, but if you as an operator purchase a building, let's say for $1 million, you buy a building for $1 million, you put your company in there, and then you spend another $500,000 building the space out. That's not uncommon to spend $500,000 building out a space. So you're into this whole space for $1.5 million. Well, if you lease that space for say 10 years, and then you decide, okay, I'm done with the building, I'm going to sell it at the end of it. If that empty building value is $1 million, still, hopefully, the market hasn't gone down, or you also have to understand like these commercial buildings are only valuable to people who are interested in doing similar things to you, especially after you build it out. So sorry, I want to make sure I get this clear. You have to understand that 500 grand that you put into building the space out, you're not going to get back in the sale of that building, because they don't give a shit, quite frankly. They're going to tear it out anyway and do something new. So the only value that you have in that building is your income that you produce and pay to yourself in that building. That's a very important concept you have to get. So what this allows you to do is, say you're paying yourself, I'm going to do some math here. Say you pay yourself 150 grand a year in rent, which is not uncommon. So if you pay 150 grand a year in rent, say that makes the net operating income, let's just say 70% for the whole building. So you're doing 105 grand a year in net operating income. And so then you can put that on the open market, or you can, have a broker approach somebody and say, hey, this is the incomes, the leases for another 10 years or whatever. Usually commercial leases have built-in rent raises, that kind of thing. So they're going to be able to see the rent schedule and the potential NOI and everything like that down the road. So if it's 105 grand, and let's just say that asset class trades at a 7.5 cap rate. Again, pulling that out of my butt. But it's a point, so it's 105 grand. We divide that by 0.075 for 7.5. It's $1.4 million. Okay. So in this case, if you've got $1.5 million into it, you can pull $1.4 million out in a sale. Now, that doesn't make a lot of sense in this particular instance, but I was just choosing numbers randomly. However, the alternate to that is that you have $1.5 million into it. You spend 10, 15 years working out of that space. You don't capitalize that return. You don't sell it off. And then at the end, when you're done with the building and you try and get out, you're basically out that 500 grand that you put into it. You're not going to get that back. And then you're out whatever market shifts there are, and hopefully you can still get $1 million for that empty building. Because I can tell you right now, an empty building in commercial real estate is really just worth the lot it's on. Maybe it's worth something to somebody for that land. It's in a particular location. Maybe somebody next door wants to expand, and it's more valuable to them. Like, you hope that happens, but it's not a guarantee, and a lot can change in 10 years. So what this allows you to do is, if you are really a business person, and this is the real concept I want to get to, instead of where, BRRRR investors and real estate investors are usually like going after passiveness and whatever in their investment. um if you can, like I said, kind of put on your big person pants and understand that the value is in the income of the property, and that if you can concentrate on producing that value or producing that income from your business and running that business well, then you can leverage the real estate aspect to either scale. So imagine trying to say it was $1.5 million to open each location. If you had to come up with that capital every time and it was locked up in that real estate, you're not going to be able to scale very much. It's going to be very hard to open another location. Whereas if you come in, you got $1.5 million into it, you pull $1.4 million out, you leave 100 grand into it, worst case scenario, then you can go recycle it and do it again. Now you've only had to bridge 100 grand gap. And hopefully, if your business is operating well, that's very easy for you. So you throw another 100 grand into your next location, you leave some money on the table. That's no big deal sometimes, and you go do it again. And then you can really, that's how this is scaled. And a lot of times, people refer to this as like papering or whatever, when you really like, start trading the notes and everything that are involved here. And really, that's what the CMBS market, that's what you hear a lot of times out there in fancy real estate world or fancy finance world. And that's commercial mortgage backed securities. And that's all this shit is people buying and trading huge commercial real estate projects backed by the fact that a business is in there operating and paying rent. That's all this is. So again, back to the whole Twitter Elon Musk thing, as soon as Elon Musk stops paying rent on Twitter, the value of those buildings goes to shit, because the value of the lease is nothing because the dude's defaulted on them, right? So I say all that to say, if you can understand the BRRRR strategy in normal residential real estate, kind of the next step up in thinking is this sale leaseback, and how to leverage that as a business operator and a business owner to go do this again, open more sites. And really, where a lot of small business owners or startups get hung up is on this concept that they always hear, where, oh, everybody gets rich off real estate, everybody gets rich off owning real estate. Not really. Everybody gets rich off owning income producing real estate. And so if you are both producing the income and owning the real estate, you're kind of holding both. You don't really have any more capital to do anything. You're holding all the risk as well. And it's up to you to produce all that income to produce the value of the building. Obviously, there's ways where you could do this yourself and like refinance it and everything like that, but then you really like robbing Paul to pay Piper, or whatever the hell that phrase is, robbing Paul to pay Peter, or whatever. So that was long and rambly. That's just how I explain shit. Hopefully that makes sense. But the concept here is that if you can elevate your mindset beyond the standard, like, I need to hold real estate to get wealthy, and understand that it's the income that you can produce inside of real estate that really matters to people, and that people will definitely pay a premium for, then you're going to be unstoppable, or you're really going to be able to scale. So that is why a sale leaseback is so powerful, why it's kind of the big boy BRRRR. Ooh, maybe that's what I'll call it, big boy BRRRR. That's kind of fun. And that's how, I mean, we see it. I work a lot in urgent cares, and we see it a lot. And that's how people go from like 2 or 3 units to 10, 15, 30 units. And then, then they start getting the eyes of hospital systems, of private equity groups, of Wall Street. And then they come in and offer you a big fat check to, take that business, because it's been proven. And now you've got 30 locations instead of 3, and you have no money left on the table. And then you get a big check at the end of it. So it's very powerful. And it's a little counterintuitive to like how we as consumers in residential real estate are taught to think about it. So if you can flip that around, flip that switch, it's very powerful. Like I said, happy to go into more detail if you have any specific questions or like specific numbers you'd like to look at. These were just pulled out of thin air numbers. And I will see y'all in the next one. And hopefully you liked it. Thanks so much.